Okay, good morning. I apologize. It just seems I have to reboot just before I go on every time. I don't know. I'm not sure. Not sure why. Not sure who can help me. But it's just the communication between an old iPad and a newer computer with a new software. I don't know. It's creating issues. So I'm happy to report that it looks like you did well on your test. Now I gave the test to the grader, and you can let me know any comments. You can write me, email me about whether you thought the test was fair. You can let me know if the grading is fair, if you have any issues with the grading. You'll see your grade. I asked the grader to mark up, make notes on your tests so that you can see where you went wrong, if you went wrong anywhere, and then he'll email them back to you, and I asked him to do that before tomorrow. So you should be getting those. Good morning, everyone. So that's good. We finished the first part of the course, the first week, and we're on to the next topic. So this week we are going to tackle techniques for valuation of alternative capital investment projects. So NPV is one technique that you've learned, and we're going to discuss others. Are you familiar with techniques? What techniques are you guys familiar with? Put it in the chat. Like in 3106, do they teach you internal rate of return? Did you learn the internal rate of return? So techniques. Actually, I have a summary. So I shared with you a bunch of documents. This one you can pull up, and then there's a summary page also where I summarize the kinds of techniques. Okay, well, you guys aren't writing. All right, so you learned some of those things. Okay, good. All right, so we're going to review that, and we're going to learn, we're going to apply it. We're going to learn about the differences between them. And you're going to solve some problems with them, and then we're going to get into capital budgeting this week. Okay. So you need to know the difference between, to begin with, what kind of project are you evaluating? Are you evaluating an independent project, or a mutually exclusive set of projects, or is there capital rationing? So what are the distinctions? When you're evaluating an independent project, so I'll just give you an example. So this is an example, so I have lots of examples. So here's the timeline. In year 0, you're looking at whether you should maybe buy a new machine. So you're a printing company, and you're looking at buying new equipment, and you've thought about it, and you've consulted with your staff, and you come up with the idea that if you do buy the new equipment, for instance, you can think of these as millions of dollars, so this is like $1 million. So these are in thousands of dollars, so these represent millions, or you can think of it as $1,000. But the idea is you invest now to get these additional revenues and expenses, we'll call them incremental, for a net cash flow at the end of year 1 of $500. Like, a lot of things happen in between here, but the idea is we're going to work with end of year cash flows, $500. And then the second year we estimate that, these are all estimated, the net cash flows will be $700 after expenses. And then in year 3, there's going to be a loss, we estimate. And then, so how can that happen? Maybe we have to do some maintenance. We're anticipating some maintenance on the new equipment, so that's going to cost us. And then at the end of year 4, we have that positive cash flow. So we estimated these, and then we want to evaluate them. We know how to do that. These are mixed cash flows. We can use the NPV. So this is the sort of thing we're looking at, okay? Now, we could evaluate that project on its own, and we do that with an NPV analysis. In that sense, we accept or reject that one project because it doesn't meet a minimum criteria. So we say it has to be positive. NPV has to be positive, net present value. But there are other techniques we're going to learn about, and they can have minimum acceptance or maximum acceptance criteria. We'll talk about that. So that's if you just evaluate a project by itself on its own merit. Another approach is to compare projects and pick the one with the highest whatever it is that you calculate. If it's NPV that you're using, then the one with the highest NPV would be the project you pick. So mutually exclusive projects means you can only afford one. So you would rank them using whatever metric you chose, and then you select the one that's the best. It could be the highest NPV. It could be the highest internal rate of return. So these are the things I'm going to discuss. Okay, and then there's the issue of what if you can have more than one project, but you have limited budget. So capital rationing. You have a limited budget, so you can do maybe one or maybe two, maybe three. It depends on your budget. So how do you choose between alternatives in that case? Okay, you with me? So we're going to do most of this at the beginning. We're going to do some independent projects. At the very end, we're going to deal with capital rationing and do some mutually exclusive project analysis in between. All right, so this involves the art of valuation. The art includes estimations of cash flows, so A for amount of each cash flow over time that you anticipate. So initial investment is either you know it or you're estimating what it should be to take on a project at some point in time in the future. You must estimate all the future cash flows, okay? Then you need the appropriate discount rate that you're going to use in your valuation to take account of the time value of money, the fact that $1 today is worth more than $1 in the future. So which interest rate should you use? Should you use the same rate, or should you use, for projects, for firms, we're looking at, so we'll talk about that, but there's a lot of terminology. Essentially, you're just trying to get the implicit interest rate or discount rate. Okay, but there's lots of terminology that goes with project analysis. So you can call that might be called the cost of capital, or the cost of equity, or the hurdle rate, or the required rate of return. There's all these terminology that are synonymous with the idea that there's a implicit rate of return in there. So what is the rate of return, and what's the appropriate risk-adjusted rate of return? We'll talk about that. And you have to estimate that. You have to guess which one should you use, and should it be the same throughout time? And you also have to estimate the timing of cash flows. Remembering in our technique in this class, we usually assume cash flows accrue at the end of the period, or they occur at the end of the period. Okay, so that is the art of valuation. So back to this problem that I introduced. So I want to, so this, I give it to you very simple like this with numbers. You have to just subtract them, but there's a lot that goes into estimating these values. How do you know the future? How do you know what's going to happen in 4 years? Just think back in your own life. 5 years ago, could you have imagined going through what we're going through right now? Could you imagine the situation you're in right now? No, you just don't know. 5 years back, what were you thinking could possibly be the case? Okay, yeah, you were younger, but even it continues. Promise me, the uncertainty continues. It's hard to predict 5 years out what's going to happen. But anyway, this is what they attempt to do so that they can make some decisions. So you might encounter this in your work or in your life, running your business. So this is just a matter of, because they're mixed cash flows, we discount each for the number of periods that have transpired and use the night present value. So just to remember, you guys are good at this now, but take a moment and plug those in. Make sure you remember how to use your NPV keys. I'll give you a few minutes. By now you should be using NPV. Sorry, you should be using your calculator in financial mode. I make a note and I leave a space here so that you can write down what you did, just so you don't forget. Remembering that your calculator is set. So let me know when you got it. Anyone? Don't forget the negative. Nobody? Still? Let me see. I'm going to check the chat online because sometimes it doesn't appear in my control panel. All right, somebody got it. I'm counting on you guys to help pace me, so let's see. Let someone else get it, and then we'll continue. So you got an answer, which means, which is positive. So that means that you accept, we say accept the project. It's a positive NPV. Do it. Go for the investment. Any questions about how to put it in? Very good, Alex. Javier. Okay, so since it's positive, we say accept the project on its own merit. Very good. So that was review. So now we're going to reflect. Oh, sneeze. Maybe that's just dust. Hold on. Okay, back. Okay, so let's reflect. What's good about the NPV is it's simple to understand, it's simple to convey. Look, it's a measure of profit in times $0. It's the value of the project. You can convey this to people who are non-finance people, right? That it's a positive, profiting project. It's a profitable endeavor. But there are disadvantages, and that's why we have other techniques to consider. The disadvantage is that well, actually, hold on a second. This is just speaking of the techniques in general. I'm missing a page somehow. I think I'm missing pages. Yeah, look, my numbers jump. Okay, I know what I did. I know what happened. Give me a break. We're missing pages. This is not the right page. Okay, you're gonna have to delete that document. I'll send you it and give me 2 minutes. Pause. Well, I hope that's not too confusing. I just sent them to you. What had happened is that I set up the printing to print on two sides, and then when I did the PDF, it didn't print one of the pages, or I don't know. It's only half of the pages are here. It's only printing one side. Anyway, whatever. You've got the new one. Open it up, and I'll get back to this document. So that's not it. So I called it all. So all the other documents are okay. It's just this one. Oh, the PDF was flawed. I think I gave the wrong number to it. I don't know. All right. Okay, so picking up where we left off. All right, so actually I don't even have a comment here. But what's wrong? Why is it that we have to develop? Why have we developed new rules, other rules than NPV? One reason is, well, the main reason is that we have to predetermine the discount rate. So the interest rate you're using, 10%, you know, how'd you come up with 10%? Why 10%? Could we use another one? What determines, how do we determine what is the right one, and how good is this? One way to approach this is to try different interest rates or discount rates and create like a sensitivity analysis, using different rates, saying, okay, well, if we use this, a higher rate, what happens if we have a higher rate with a higher rate? Then that's going to discount stronger, and you're going to have less projected future revenues. So, or cash flows. So, how high can you go? So to get a threshold, like a range of good discount rates, a different approach like the internal rate of return approach would be more helpful. But if you're sure, this is the rate you want to use, this is the rate that you would ever invest these dollars at, and this is the appropriate rate, then you're convinced, just use NPV. Otherwise, you might go for other techniques. Okay, so another technique that is just we call it a back of the envelope. So in English, that's what we say, but it's just a quick estimation, right? Someone to communicate with someone about this project that you're about to embark on. Let's say you're looking for them to help you and you want them to invest. One question they'll ask likely is, well, when do I get my money back? And when do I start making profit? When do I start making money? So the payback period rule answers that question. How long does it take the project to pay back its initial investment? So that's just focused on getting your initial investment back. We define it formally. The payback period is the number of years to recover costs of the project. So NPV was dollars. Payback period is in years, okay, just to be clear. You can use the payback period for both independent projects. So you have to establish a number of years. It's like you'd have to say, or someone have to say to you, look, I'm not going to invest in your project unless I get my money back in 2 years. So that would be the maximum they're willing to invest at. Or if you're in a big firm and you're working in the finance department, then your superiors, they would determine what's the maximum acceptance criteria. If you have to choose between projects, and you have to present alternatives to the project you're proposing. Then you would present the payback period for several projects. You would rank them, and then determine, depending on which ones are, which ones pay back sooner, you'd go for that. You'd approve that project, or you'd be able to convince investors for that project, or convince your superiors about that project with the quickest return in terms of years. Okay, so how do we calculate it if you've never done this before? For some reason, this is just arithmetic, but for some reason, it blows people away. So don't get confused by this. It's a very simple arithmetic calculation. You can add it to your formulas on your formula sheet. Here's an example. So one point to make about the payback period is, and I'm making my example for discounted payback because we're in finance, we are aware of the time value of money. We're not just going to go for the payback. Payback would just look at these two columns. And in terms of this project with initial cash flow of 1,000, the payback period or I can use the notation so the payback period would be PBP. So at what point do we get the $1,000 back if we just look at the cash flows, the nominal cash flows, right? So 200 and 400 makes 600, and then 600, 700. So between the second and third year, you would get it to pay back. That's if you didn't include discounting. Let's discount each future cash flow and work with this instead. If we do that and create cumulative cash flows, that's what's done here. So what they've done is so it's like it's like a fourth column here of accumulated discounted cash flow. So I've added this and this to get this amount. And then I'm going to add this and this to get this amount, you see? So it's cumulative. And you could do that here too, if you just looked at the cash. So if you did cumulative cash flows, this would be 200 in the first year, and then 600, and then 1100. Sorry, yes, 1300. And then 1600. That would be accumulated cash flows that are not discounted, okay? But here, if I discount them first and then accumulate them, which again, I could put it here. But anyway, we'll work down here. So to figure out precisely the duration or the time that it pays off, you would get the closest year, which is 2. That's not 1,000 yet. The 1,000 happens between the second and the third. So we need to interpolate, that's what it's called, between these 2 years. And the way you do that is you take the remaining amount. So between here and here, how much does it take to get me to 1,000? Well, that's calculated as 1,000 minus the 513. So that leaves 487. So that's the remainder. And then you divide by the cash flow that occurs by the end of the third year. So you need this value, you need this value, and you need the 1,000. So that makes sense, I hope. So this is so we're scaling it by, so we're taking the 526 that we make in the third year, that we anticipate making, and we spread out what remains over the 526. So it's like, evenly spreading out the 526. And then making a fraction of what remains to make a complete 1,000 after the 513. So that's yes. So those are the numbers you need. You need 1,000. You need the cumulative here. I mean, it's here too. And then you scale it over the amount you make in the third year. Okay, so this is the formula. You can put on your formula sheet. Just don't forget how to use it. I don't know why, but students just are blown away by this concept. But this is interpolation. So you're trying to find the fraction of the third year till you make 1,000. You make the difference for 1,000. So you get 2.93. And people would say, oh, that's 3 years. But if you're comparing it to a project that pays back in 3 years, you want it to pay back sooner, you would go for it. You would go for this project. If you are just evaluating the projects and you were only going to accept a project if it paid back in 2 years, then this one would not be approved. So somebody asked, why wouldn't I discount it? Some people don't care. I don't know. If you're talking to people who aren't finance people, they don't understand this. So you won't discount it for them. You just show them, and you anyway. If you don't discount it, and you're very rough about the numbers, it's going to happen in the third year, right? So you could say that. So before the end of the third year, whether it's discounted or not discounted, you still have that information. This is more precise. This is why somebody would hire you in a finance department. So, but if you're communicating with someone who's not versed in finance, you could show them this and then just show them, but in finance too, it's less than 3 years it's going to pay back. All right? So you have to think of your audience. That's the most important thing. If my English is too fast, let me know. You can watch the video too and review what I've said, so don't despair. You have opportunity to review what I've said. I hope you don't hear my voice in your dreams. Well, I don't know if that's so bad, but if you're watching the videos so much, I see you watching them quite a bit. There's quite a few views, so that's great. That's good. It means it's been useful for you. Okay, so we've learned. Let's recap. Done a lot here. We learned so far, right? We reviewed NPV. We've discussed the payback period rule and the discounted payback period rule. So we've done all of those things. These are in dollars, these are in years, and these are in years. So they're different metrics, different numbers. And let's reflect a bit and think, why would we not use the payback period rule? Why would we choose NPV over the payback period rule, even the discounted payback period rule? So we know the difference between these and this, right? This is discounting, this is not. Usually, maybe sometimes they'll give you the same answer. But what's the big difference between these and NPV? What is a disadvantage? What are the advantages? And that's the slide you saw, okay? So a disadvantage of using the discounted payback period would be the maximum acceptance criteria, so like the 2-year cutoff or 3-year cutoff, that's arbitrary in that somebody higher up is deciding it, but does that make it the best? Like, how could you make a statement against that? If you're stuck with the discounted payback period, you can't really convince them that maybe this is worthwhile, because later After the 4th year, you make this much money, and it's pretty much guaranteed. If you're looking at the payback period and the discounted payback period, they don't care about future cash flows. They're not going to care about what's happening over here. What if this was 10,244? Well, if they cut off at 3, if they say, well, we're only taking projects that are 2 years, payback in 2 years, how do you incorporate the 4th year? How do you promise them, or how do you demonstrate that they got to hold out and they'll see the reward? So that's why the NPV could be used to make that argument, right? And you can wrap in, you can roll in those future cash flows using discounting and say, look how high this is. Forget about your 2-year arbitrary threshold, unless they have a real reason, like they're going to go bankrupt if they don't get the money back in 2 years. You want to be able to account for those future cash flows in a nice, succinct way. This is all about presentation. This is about making arguments to people who might not understand finance. So, so that's the problem. Okay, so the arbitrariness of this 2-year threshold, and the fact that you don't include in that calculation all the future cash flows. You're missing some of them. Okay, you're missing possible, maybe if the project is, maybe if in the future there's a huge loss that you anticipate, you haven't even included that in the calculation, so that's not good. Or there's a huge windfall coming after some years of sacrifice. So that's the problem with if your focus is, though, however, on getting the money back, or that your superiors need to know, or your investors need to know when they're getting their money back, and that's really important to them, then you calculate this. You could accompany it with a calculation of net present value, however, if you have concerns that something is being missed out. All right? That brings us to internal rate of return. So, whereas NPV gives you a dollar amount, payback period rule gives you years, and discounted payback period rule gives you years, internal rate of return gives you a percentage. The internal rate of return gives you a percentage. So I'm going to explain this slide after, because there's more of a summary slide. So what is the internal rate of return? So taking a set of cash flows, like these ones, with initial outlay. So this is C0 here. The internal rate of return is the implicit interest rate, the implicit discount rate, or the implicit rate of return that gives you a break-even project. So we interpret it as, so we're going to solve this for the discount rate in here. So this is looks like the NPV, right? But I solve for the rate that gives me a break-even NPV. It's not a positive, but it's just 0. We're basically, we net out. We don't lose, we don't gain, but we don't lose anything in this project. So this is interpreted as the internal rate of return. So it's the rate of return of the project. That's how we interpret it. Okay? Now, how would you solve this algebraically? Can you solve this? Think about it. Can you isolate the rate? Can you isolate IRR, which stands for the discount rate in here? Can you isolate that algebraically? Can you solve for IRR? So we've seen this before. There's no analytical solution to this. Okay? There's no analytical solution. It means I cannot isolate IRR equals something. The solution has to be done with, you can use tables or computers. Our computer is our calculator. You can also do this in Excel. And what it does, it looks at, it has the formula of this equation, and either it programs this way or this way. And what it does, it keeps plugging in rates to try and get close to 2,200. That's what it does. So it iterates. So that's a very powerful process. When it goes beyond or too low, if it overshoots, so if it goes too high or if it goes under, then it picks different, it picks numbers in between. So we're going to learn how to use our calculators to solve for internal rate of return. There's a couple of things that have to be pointed out in doing this. Here's an example. These are the same cash flows. I've used the same cash flows here. And a discount rate of 0 and calculated the NPV. Same cash flows, but put 5% as the interest rate or discount rate to get this NPV. And then so on. So you should be able to generate this table. Okay? So what I need you to do is take those cash flows here, initial investment and these cash flows, and confirm to me that you can generate this table here by changing the discount rate each time. I'll give you a couple minutes. Anybody get it? Nah, no comments? So what you're doing is putting these cash flows into your calculator. Putting these cash flows into your calculator and then entering I don't want the IR right now. I just want you to do this right now. I'll show you how to do that in a second. I want this. NPV only. Okay? What you're creating here is called the NPV profile. So what you're doing is CF $2200 negative, enter down, C0 is 800, enter down, frequency 1, enter down, cash flow 2 is 900, enter down, frequency 1, enter down, cash flow 3 is 500, enter down, frequency 1, down, CO4 is 1600, enter down, frequency 1, and then nothing else. So you need to, if you have a problem, you have to clear work, second, clear work, and enter everything. Okay, some people got it. So you begin by hitting CF0, remember? So this is why I have this space. So CF0, sorry, you hit CF, just hit CF, and that will remind you. So you hit CF, CF0 comes up, you put 2200 negative, enter, down, down, and then no, you say enter down. Then you do 800, enter down, down, then 900, enter down, down, 500, I'm doing it right now, that's why, enter down, down, and 1600. I mean, I can show you my calculator, but I think you guys know how to do this because we did this already for the test. Then you say NPV, and there's an interest rate. For the interest rate, you plug in the different rates. So for the first one, you enter 0. So you put 0, enter, down, and then there's NPV. You say compute, and you get this number. I want you to get the profile. I don't want you to get IRR right now. You need to generate this. Then just change the interest rate 5. So go back to hit NPV, and I comes up. So pressing NPV. So you press NPV, and then you have to enter the new I. Put 5 in there, enter down, compute. Okay? You need to use compute. So you keep changing it. Make the whole table. It's very easy. This is the first one, takes some time, but then it's easy to keep changing. I'll wait for some more people. Make sure you've got it. I don't want you to get the IRR yet. I just want you to get this. IRR is easy. You just press IRR compute, and then you get that. So for IRR, then you say IRR compute. Some more people? There's so many. You're 26. I want to see some more people who got it. The NPV profile is something I can ask you for, and it's something you need to know how to generate in the case that your calculator is not going to give you the right answer, and I'll show you how that happens, what that looks like. So you see here, this is always positive, so it's positive NPV. So accept the project, 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 and then, here, NPV is 0. NPV is 0 somewhere between 20 and 25. And this is what the calculator will realize. Okay, so the calculator will put these in. So you're replicating what the calculator does. And again, you might ask, why am I going to do this if the calculator can just find it for me? Well, there's sometimes the calculator cannot find it for you. So this is the reason why anybody would want to buy a more expensive calculator. The HP 10B2, it will calculate multiple IRRs. It might not just be one. In this case, there's only one because of something. Why is there only one NPV? Why is there only one NPV? I was saying NPV. Why is there only one NPV equals 0? NPV equals 0 here and nowhere else. I'm waiting for you. A lot of people are stumped or they're not responding. Oh, let me check the live stream. Maybe you are responding because this one's just slow. No, it's still same people. I'm waiting. I'm not going to continue until I hear that you guys got it because it's all going to be a huge blur of 2 more hours if you don't get this. Do it. You're going to just wait. Don't wait for me. I'm waiting for you. Okay, there you go. Some people got it. Okay, so what you got was not just the IRR, correct? You got the profile. Good. Okay, so you got all of this. Very good. So now you know how to do that. Make a note on your pages or wherever you're writing notes that you did that you know how to do this, because somehow people forget. It's forgettable, I guess. I don't know. There's so many other things that you learn tend to forget some of it. So make some notes about how you did this. So there's an NPV equals 0 in between here and here, and the calculator will pick, like it'll go for what's between 20 and 25. It's like 22.5. So it'll try like 22.5. You know, it'll go halfway, and then depending if it's positive or negative, then it will go halfway between 20 and 22.5. Or 22.5 and 25. Okay, so this is iterative. This is that iterative interpolation to find when this makes 0. So my question was, how do we know that there's only going to be one place where NPV is 0? What is it that tells us that? Now you can think mathematically. This is a mathematical question. And you all seem pretty good at math. So it's true for this investment and these cash flows, they will only create an NPV of 0 once. But why? How do I know there's only one? So mathematically, you know, these are just going down basically. So it's going to dip into the 0. So like you get this graph, right? So this is here. Pay attention to this is the NPV on this. So this is like your profit, right? This is net present value. And then here I'm going to plot the discount rate. So I put higher and higher discount rates, and what that does is it reduces the value of the present value of future cash flows, right? So a higher discount rate reduces the present value of future cash flows, making it less likely to offset the initial investment of 1,600 of $2,200 dollars. So it's $2,200 investment offset by those cash flows with no discount rate, and then when I increase the discount rate, I'm reducing the value of those future cash flows. The reason why there's only one NPV is because this is a monotonous function. It just goes down. It doesn't go up again. And we know that happens because the cash flows are all positive. When the first cash flow was negative and the rest are all positive, this is called an investment project. And it will result in this pattern with one NPV only. NPV equals 0 only once. With one IRR. So the way that we find the IRR on our calculator is pressing IRR, compute, you'll get it. So some people might understand this graphically better than with the cash flows. So I hope you're getting it. Some people will just get it off the bat. Some people understand both. So I offer you these two ways of seeing it. The most important thing to realize, though, that there's only one NPV because the future cash flows are all positives. So what do we do with this number? Well, notice NPV is positive here. So only with these discount rates should you accept the project. So this is more information than just calculating the NPV. I've calculated an infinite array of NPVs. That's a lot of information. So how I conclude is as long as the discount rate that you use to evaluate or assess projects, as long as the discount rate that you usually use is smaller than 23.3%, you should accept the project. That's what it means. Okay? So the internal rate of return tells you the threshold. To break even, the discount rate should be 23.3. So after that, you're going to lose. So if a firm has a discount rate, or if you're thinking to yourself, well, you know what, I'm gonna invest in this project myself to duplicate my business. I'm going to invest, and I'm going to buy a separate shop. I'm going to purchase a building and do a bunch of things. This is thinking. And if I don't do this, what I'll do is I'll just invest back in my own business. I'll do something else. In my business, I use a 15% rate of return. And we'll talk about how that's calculated more, but this is a required rate of return. So in that case, definitely it's smaller than the internal rate of return. So this project, you can think of it, you can interpret it, it returns at 23.3%, which is way more than I was expecting. So yes, go for the project. But if you're expecting 25%, this project is not good enough. So you would reject the project. All right? So let me know if you get it. If you don't get it, that's how we do this. So positive cash flows with an initial investment, one place where NPV is 0, so there's only one internal rate of return. the cash flows, the net present values will indicate that it'll always be positive until the 23.3. So you accept the project as long as the predetermined discount rate was within that range. Okay? All right, let's do some more and maybe it'll all click. Here's another one. All right, so this is actually different, right? Make sure I didn't lose some slides. Okay. Okay, so this is different. This is a positive initial cash flow. So this is your initial investment is positive. Weird, right? So we got to think about what that means. And then they're all negative after that. So this could happen. This is known as a financing project. Okay, this is a financed project. It means you got some money up front and then you had to pay it back. Or let's say you're, let's say you're conducting an event, like a promotional event, and you've taken membership fees or some sort of event fee, and then over the period of the project, so a project in this case is the event, and the event takes place on a 3-year basis, right? On an annual basis, we offer the event to the members who have paid upfront membership fees, and this is at the end of the year, this is what we've estimated it would have cost us, and at the end of the second year that much, and the end of the third year. So this is a financed project. This is different from a investment project. You can say it's a financed or financing project. Again, for calculating the IRR, let's say we don't have a discount rate, we just want to get an idea of when this project should be selected on its own merit. So what we do is set up the NPV equals 0. Now you can think of it again like this or like this. And what happens is the calculator is going to keep on entering discount rates until the NPV is 0. So at the beginning, if you see the NPV profile here, for 0 discount rate, you get a negative. As you go up, the discount rate becomes positive. So take a moment, clear work on your calculator. So second, clear work to enter these values, all right? Also, I'm not sure what negative 1.42 means. So if you enter these cash flows, oops, missed a page. If you enter these cash flows, wait, where's my project? Where'd my project go? Oh, it's above. Why do I forget that? That's terrible. Okay, so this is so 4,000 and then negatives. So let me know if you've generated this NPV profile. So what the calculator will do is put a 0 in and get this number, then keep going because it wants to approach 0. So higher, higher, and then we got 0 and we're going up. So it means NPV is 0 in between 10 and 15. So then the calculator will choose numbers like right between. So it'll try 12.5, and depending if you got a positive or a negative, we'll go closer to 10% or 15% and keep iterating that way. Very good. Okay, good. So mathematically you guys can do this. Now we got an intuitive, we have to explain this, what we've got. So the results, you could calculate it, continue iterating like this. If I put in 12.5, so then I would expand this and create a new, let's see if I can do that. That's okay, it'll be messy. So then we have our calculators, we spent money on them. Let's ask for IRR, compute, and you should get this number. So if you're getting stuck, if some people are getting stuck, it's just because you're not, you're missing the step, either compute or you're forgetting to use the arrows. Well, that's might be a typo. So that would be 50-30. Thank you, Brenda. Let me check. I tend to believe you though. Yeah, that might have typo there. Okay, Monica. Yeah, I'll believe you, both of you. So this should be 50-30. Thank you. 50-30. I'll remember you guys for this. Thank you. So that should be 50-30. I can edit that in my notes. Thanks for letting me know. Okay, great. Very good. Okay, so how do we interpret? So we got the number. What do we do with it? This is a financing project. This is a financed project. This means that, notice, well, if you look at the NPV profile now, it's going negative to positive. It's going up. Why is it going up? Because the way the cash flows are. The first one is a positive and the next are negative. So the first one is positive and the next ones are negative. So anyway, I can look at it this way. So these, as the bottom is going up, the overall negative number is going down. So as this is going up, the overall values are going down, right? These are going down. So this has more potency. So this becomes, the positive becomes able to offset the negatives. So that's what's happening in the picture. So this is going to be going up. And remember, this is NPVs that we computed with different discount rates. So it's showing that this is where NPV is positive. So IRR uses NPV, but it gives you more information, all right? This is the thing you need to take away from this. And it's telling us that as long as the discount rate is higher than the IRR that you calculate as being here. Not there. Here. As long as the discount rate is higher than that, then you should accept the project because the NPV will be positive. So we interpret this therefore as a borrowing rate. So this says that it's not the rate of return, it's the rate of borrowing for the project is 14.37%. Okay? So we should only accept the project if the internal rate of return, if the required rate of return is higher than that. So what are we saying here? When you borrow up front, you like to have a low rate, correct? You want a low rate. So if you set for projects that your required rate of return is 15%, and this project has a borrowing rate that's smaller, you should accept the project. Okay, so this is the reverse of what we said before. We wanted a high return, but you want a low borrowing rate. Got it? So that's how you interpret this. So as long as this is higher, you accept the project. As long as, let's say it the other way. So I'm using RRR for the required rate of return. So the preset rate, so 15% is what you usually use for your projects, like we did for the previous investment project. Then that means that as long as the borrowing rate is lower than the required rate of return, you should accept the project. If it's the reverse, you will reject the project. It's too high. It's not worth it. So we have a summary here. For investment projects, you want the rate of return to be high for the project. So the internal rate of return to be higher than what you preset. And for finance projects, you want it to be lower. You don't want it to be greater than. You want it to be lower because it represents a borrowing rate. Now this only works this way as long as the cash flows after the initial investment are positive. So there's only one sign change. It doesn't change. It's a negative that goes to a positive. And for finance project, the first one is a positive, and then the rest are negative. Only one sign change. So this is a summary here. You'll see that in the summary sheet I gave you as well. All right. So what happens if you don't have that situation? So now we're going into uncharted territory. Who's done this before? Anyone done this before? So we have here cash flows that vary. So we're becoming more and more realistic. So some years with the initial investment up front, some years there'll be positive cash flows and some years negative. So maybe you will have to invest up front, you realize some returns, and then you have to restore something or repair. So let's say it was like a gas station. You wanted to start a gas station. You ran it for 4 years. At the end of 4 years, you anticipate that you're going to have to do some repairs to it, and you have to do some updates, right? You have to maintain it. So you anticipate this expense. So again, you can think of these as millions of dollars for thinking of a larger firm, or you could think of these as smaller amounts. You can think of so sometimes I'll use K for thousands of dollars. you'll see that. Okay? You can think of these as Ks. All right, so what happens with changing? So these change from negative to positive once, and then positive, and then back to negative. So there's 2 sign changes. Got that? Negative to positive here, and then positive to negative here. So what that means mathematically is that you can have up to 2 places where NPV is 0. So it's going to cross the axis of NPV 0 possibly twice. It doesn't have to be twice. I mean, even for the case where NPV was going up, it might not have crossed. So imagine a curve that always stayed above NPV 0. You can't solve for IRR because it never hits NPV 0. But does that mean you should reject the project? No. The rule is NPV greater than 0 is a project you would accept. So any project like this, you would accept it off the bat. You wouldn't need to do an analysis. It's always returning a positive NPV. And projects like this, analogous to that, as if in this case you can't calculate an IRR either, it doesn't cross where NPV is 0, but these are always negative. This project is always a negative, always a negative NPV, so reject this project, okay? But sometimes, you know, if you have up to 2 sign changes, you can have up to 2 IRRs. It might cross twice. And I'll show you some examples. And I think I'm going to use these numbers. Let me confirm I'm using those numbers because I think. All right. So here are the cash flow. So I want you to generate this NPV profile. I'm going to take a 5-minute break. I'm going to give you the time to work on this. Please let me know. Text me if you don't understand, because I don't see a lot of people writing that they're getting it. And you guys, there's 25 of you, so I want you to know more of you are getting it. So try and generate this on a sheet of paper, year, cash flows, and then the NPV profile. Show me that you can get this. Don't worry about the IRRs right now. We'll talk about that, of course. But what I want is this, okay? I'm going to go get a glass of water. Text me or write in the chat if you have questions or comments. Oh, yeah, I'm back. What's going on? You got this? All right, did you get this? So you generate with, so I give you, so what's going to happen is in the exercises that I share with you for practice, I will sometimes tell you to generate the NPV profile and I'll give you the numbers. Sometimes I'll just tell you to generate it and I won't give you the numbers. So it happens that you have to go all the way back in this one to -10 all the way up to 35. Some other exercises in this set of lecture notes where we even go higher. Okay, so you got different numbers. Oh, for -10 you got negative. Okay. I'm taking note. A screenshot. All right, so I'll fix those anyway. So basically, you got what I got here, right? In terms of the signs. That's the most important thing. But yeah, the numbers are important. I'll fix my notes if those numbers are wrong. Okay, so what you found is between here and here, NPV is 0, right? Because this is NPV is 0. So the calculator will pick a number like 12.5. And then check if NPV is positive or negative. If it's negative, so it goes from a negative to a positive here. If it continues to be negative, then you got to go closer to 15. So then it'll pick 17.5. So if it's negative, it's still negative, you see? Negative and then another negative. Then it'll pick a number closer to 15 to try and find the 0. So it'll go and it'll look for if it's positive or negative again. Okay, and it'll continue like that. Let's say it was positive. So now it crossed. So now it'll go what did I do? I did something wrong. Between 12, not 17.5, that would be, oh well. Let's see. So if it was a negative, then you still have to go further. That was my point. So if it's a negative, you have to go further. So you have to go somewhere between 12.5 and 15. So evenly between 12.5 and 15 would be 13.75. So 13.75 is what you would check for positive or negative. In this case, it's actually going to be the other way, right? It ends up being a positive, so it means that you got to go closer to 10, and you end up halfway, well, between 10 and 12, it's 11.52. Okay, so how does the calculator find that value? You ask for IRR compute. IRR compute might give you this one, or IRR compute might give you this one because it happens again. So which one does your calculator give you? Or do you get both? If you have an HP calculator, you can get it to give you both, but I don't think any of you have that, so I won't go into that. If you have an HP and you want to know, let me know. You basically have to give it a starting value. You have to overshoot. these values and put an interest rate high or a discount rate high and then ask for NPV, and it'll iterate towards this one. If you put an interest rate low, and press NPV IRR compute, it'll iterate for this one. So which one did you guys get? 11.52 or 29.84? Okay, so you guys are getting 11.52. And so, how the heck are you supposed to get this one, right? So what you have to do is you have to do this. You have to make the NPV profile. So if you know there's more than 2 signs changes, so if you see more than 2 sign changes, like we did here, we have to generate this profile and look for the 2 rates. Now, in this case, we were able to get this one precisely, so give it to me. This one not so precisely, but you know it's between 25 and 30. So try something in between. So put 22.5. Sorry, 27.5. And you'll know, because we already have the answer that I give you, if you put 27.5, it'll tell you that that is a positive. So you keep going. So then between 27.5 and 30, is 28.75. And it'll still be positive, so you keep going, okay? So you realize it's at least 29, right? So you could just round it at this point and say, okay, 29%. It's actually even closer to 30 than that, but you know, I don't expect you to be down to the 2 decimal places. All right? So you could say it's 29, between 29 and 30% could be your answer. Are you understanding that? How do you do this if the calculator can't do it for you? Well, you need to know what the calculator is doing, and you need to replicate this portion that doesn't come on your calculator. And why would you know to do this? How do you know there's going to be 2? Because there's 2 sign changes. You have to look for the 2. Now, why do I need to look for the 2? One second. I have it saying HP calculator, don't I? So if you have an HP calculator, I actually have that space. Anyway, just for your calculator, ignore this term here. Whatever calculator you have. You can leave notes for yourself in the space here of how you did it. If you actually have the HP, like I said, put an interest rate that's higher, like 30%, and then ask to compute IRR, and it'll find this one. Okay, if you're with me, why did I do that? I did that so I could generate the NPV profile. Now you can do this graphically, or you can just look at the cash flows, or sorry, the NPV profile that we just created with the cash flows. The point is that in between there, so in between approximately 10 and 30%, NPV is positive. That's the most important thing, okay? So in conclusion, as long as the discount rate that you use, so if we still apply the 15%, that I was using before, and I said that is my required rate of return, at 15%, I would accept the project. And I would accept the project for any discount rate between 11 and about 30%, but nothing for no other discount rate. So this doesn't force you as an analyst to one discount rate. You give a range, okay? So anything between 11.52, or you can even say just 11, and 29.84 or 30 will be sufficient. So it's pretty much an n-degree polynomial, exactly. So mathematically, that's what's going on. So someone asked me, why would you, so Alfonso asked me, oh no, you guys are talking to each other? No, somebody asked me, Alfonso. I don't know, I thought somebody asked me about why would we consider a negative NPV? Yes, Alex. Why would you consider a negative percentage? The main reason you would use a negative percentage is so you can draw the curve, okay? You just want to draw the NPV profile. You're not going to use it, but you need to draw it. You need to see where it's positive in the profile and where it's negative. So you could have seen that here, right? Negative, negative, negative. Then in here is the profiting range. So this is where, this is our focus. And then another question was, how do I know it's 29? Well, I explain here that you can just keep going with this approach between, it's between 25 and 30. So the number between 25 and 30 would be halfway, 27.5. Since it's positive, that means we haven't crossed the line yet. So then we pick another number closer to 30, 28.7. You still get a positive. So we haven't crossed the line yet. That's how we know it goes to 29. Or closer even to 30. I'm just rounding it. So that's how you do that. Okay, so you expand, or you iterate right in here. You expand with another table. And what I really care about is the positives or negatives. I don't really care about the quantity. All right. So that's what I mean. Like, we're going to continue with this. So if you don't get it, let me know so you can get it. Because I'm just going to do some more of these. So you don't have to draw the curve. Like I say, you don't have to draw the curve. You can just say it. You can see that here. You can see that it's positive here. But it's the illustration is lovely, isn't it? You could draw the curve, essentially. You would see it's a polynomial, it's a smooth curve. All you need to know is where it turns, where it's positive, where it's going down, where it's going up, where it crosses. NPV of 0. Okay, remembering NPV is on this axis, the rates are here. All right, so remember we talked about investment and financing projects. That is not the language we're using now, okay? All we're doing is creating the NPV profile and looking for the region where it's a positive NPV. So here's another set of returns. Here's another story. So this is known as multiple internal rates of return for independent projects. So, assume you are considering a project for which the cash flows are as follows. So we look at these. It looks like an investment project because it's a negative, and then it goes to positive, and still positive. But then it goes back to negative. So there's 2 sign changes. So there could be up to 2 IRRs. So if you had like, if this was your NPV profile, and your discount rate is here, it will cross, let's say it crossed once, and then turn, but didn't cross again. That's possible. So that's why I say up to 2 sign changes, okay? It might not cross twice, but it could. So let's do that. Make the NPV profile. So I leave it blank for you here. So you generate the NPV profile with those cash flows. 900, 1200, 1300, and negative 1200. Okay. So do that. And see if you can find the 2 IRRs. Okay. Okay, so you got 1. And then so if you just enter those values into your calculator without generating the profile, you will get which one? So if I put these in my calculator, so clear work, 900 negative, enter down, 1200, enter down, down, 1300, enter down, down, and 1200 negative, enter down. And then NPV, an IRR, compute, and I get the negative 29. So negative 29, so here's that question. A negative rate So negative rate means that you pay. If this is you or your company, you're going to pay that rate for every dollar, So this is we don't consider this negatives. Usually discount rates are positives. So I'm just using this to help me draw the curve, all right? It's usually the case that discount rates used by firms will be positive. So we would say we accept the project provided it's up to 0 or more. So if you just use your calculator, you would have got negative and you would have no context to understand what the heck that number meant. That's why you need to generate the profile. So since it's a negative, you got to start out in the negative. So you would start at negative 30 and go. It looks like you have to go quite high, but let's use, since it's a large range, I can just go from negative 30 to 0, because that's where I'm going to start, and then I can go 15 and then 30. Actually, no, I'm going to go even more. I'm going to just do 30 and 60. So you see, you can make it really detailed or not so detailed. So I can go like that, right? So those are my rates. And I enter those in by hitting NPV and changing so enter down and ask for NPV, and I get a negative. So this is the most important thing, not the sign even, that it's a negative. If I change the rate to 0, enter down, I still get a negative. I get a positive, sorry. I get a positive, and then I put 30, enter down, enter down, compute, and I get another positive, and 60, enter down, I have to hit NPV for the I, 60, enter down, compute, and so it's going down, but it's positive, and then it's going to be negative here. So then I have to expand in between here and here, right? So I have to go 60, 70, 80, 90. You see, this is the technique. And then what you're going to see is that it's going to be positive, positive, but then turn negative. So then you're just going to focus on here and then iterate in between 70 and 80. So if you have an HP calculator, you would put in your calculator as an interest 90 and then ask to compute the IRR, and you would get the exact number, or you could put even 80. So you have to overshoot the number so you can get the higher value. And it looks like some people have an HP because they're answered me, or they're answering precisely. So if you can't answer precisely, or if you know how to use Excel, you can get it precise. And you get 72.25. So how do we interpret this? Since firms will use a discount rate that is, or a required rate of return that's a positive, then you accept the project for all these rates. So this is a very profitable project. Doesn't even matter. Up to 70% return required, you should conduct the project or invest in the project. Okay. So that's how you interpret that. So how do you know what numbers to use? Well, first I start with these in my calculator and I get an IRR. And the IRR here was negative 29 if you use the calculator, if you compute IRR. Okay, so that's why I went all the way and started back here. And basically, I would suggest, okay, if I give you the numbers, use the numbers I give you. If I don't give you the numbers, go by 10. In this case, it would have been a long presentation if I went by 10, but go by 10, okay? From the beginning. Is that all right, John? So in an HP or whatever calculator you have, you should be able to generate an NPV profile. Okay, one more. I think it's just one more. Assume you are considering this project. Here are the cash flows. So amount up front that you get, and then you disperse the funds, conduct the project, then another year of conducting, and then you see your return out, dollar return out here in the 4th year. So there are 2 sign changes, positive to negative and negative to positive. So up to 2 IRs we have to search for. This drawing turns out like this, okay? So I've drawn it for you. You can confirm making the NPV profile. And now what do we say? This can happen, right? What do I care about? I care about the positive region. So as long as the discount rate is not between these two, you should accept the project. Okay, so as long as the discount rate is between 8 and 35%, so the firm has to have a required rate of return. We had been using 15%. So in that case, we would not accept the project. In between here, the project is not accepted. Only outside is it accepted. I think I said the reverse. I was kind of out of it. So yes, it's only in the red region that we accept the project. So between those two, so why does that happen? It's because of the way we're discounting the cash flows. We want to discount negatives at a high rate, but we want to discount positives at a low rate. And we have both going on here. That's what's happening. Okay, so it's a trade-off. This is so high, I don't want a high rate of discount for that amount, because that's a larger amount, you know, than these 2 cash flows. So, but these 2 cash flows, for these 2 amounts, I would like a high discount rate. So there's a trade-off between, tension between those cash flows, and that's what turns out this drawing. Okay, so you can generate this. You don't have to make the exact curve, you know. You can do it with the profile, just like we did all these times here. Okay, so you generate this. You can make a drawing from that, but if you have this, it's enough to be able to make your conclusion. Okay, so work on that. Just confirm that for yourself. Confirm the values, all right? And that brings us to the next topic. All right, so just going back, because this is a lot of information. I think these are good exercises, examples. So just review them, okay? Just review them. What am I doing? I want to go back and talk about the slide that I skipped. All right, so in conclusion, I should probably put this at the end, but anyway. Depends if you're reading or if you're following the lectures. But now that I've discussed that, now this makes more sense. So IRR is the discount rate that sets the NPV to 0. We make a reinvestment assumption when we do this. Brenda, how do you calculate the second IRR? The way that you do that is the way we did it before. We make the profile. We make the profile, we find one, but we know there might be another, so we keep going. And we see the sign changes here. So then we go between 25 and 30, we expand. We use 27.5, so halfway between. We see it's a positive, we keep going because we're looking for a negative. Go to 28.75, closer and closer to 30 always. Another positive, keep going. So after 29%, it's likely, you know, that the negative will appear because by 30, it's a negative. So even 30 would have been fine if you just said 30 on this one. Similarly for that one, it's the same thing. You make the NPV profile. That's the way you find it. Okay? So confirm with NPV profile. You have to make it yourself. Or get an HP calculator. But then you don't get to learn the richness of these NPV profiles. So back to what I was saying here. Okay, so we use a reinvestment assumption. The IRR calculation assumes that all future cash flows are reinvested at the internal rate of the return. Okay, so that's how we make this calculation, that we're always using IRR. So for independent projects, and the projects are investment project, we will accept the project as long as the return on the project exceeds the required rate, because this is the required rate of return. It's a discount rate that you set, or management sets. The disadvantages that I've actually resolved was that doing it this way alone does not distinguish between investing and financing projects. But I taught you how to handle that. So we actually learned how to deal with that situation. I'm trying to make a check mark. Use my finger. So if IRR does not exist, we talked about how to deal with that. Either the project is always above the line of NPV equals 0. In that case, you go to the NPV. Okay, if there's no IRR, you go back to the NPV. If there's multiple IRRs, we're depending on the NPV, but using the IRR calculation to determine thresholds for accepting the project. Ranges where we should accept the project, and the ranges are where NPV is positive or greater than 0. Okay, so that we've dealt with these situations. Now we're left with this one. That's how you deal with independent project. But what about problems with mutually exclusive investment projects? So that's when you have to look at two projects and you have to choose between two projects, okay? The advantages of IRR is it's just a percentage. It's a simple number. After all these calculations, you end up with 1 or 2 percentages. And it's a really nice way to summarize everything. So it's easy to understand and communicate to non-finance people. And in terms of solving for a mutually exclusive project, we're going to talk about that. But in general, if there's no conflict that we're going to discuss now, we would just select alternatives with the higher internal rate of return. So let's pick up where I left off. So if you have two projects to analyze at the same time, what happens with IRR needs to be discussed. We have to deal with the situation. What is the situation? Well, the situation can arise due to a problem of scale or a problem of timing. Here is an example of the problem of scale. Think about yourself. Which of the two opportunities would you choose? You have to choose between one or the other. Either you give me $1 now, and at the end of this class, I send you through ATH Mobile $1.50. This is a low budget project compared to the second alternative. You can give me $10 now, and then I'll give you $11 back at the end of the class. Which of these two would you pick? Opportunity 1 or opportunity 2? Write it in the chat. Anybody else? Very good. So you guys learned this before? Or you're just logical? So you have the intuition, have you learned this before? And now explain why you would choose number 2. So most of you picked number 2. In terms of the NPV, which is like the fallback, okay, we always fall back on the NPV when our alternative techniques fail. In terms of NPV, by NPV you should choose 2. But if you use the internal rate of return rule, there's a little bit of a dilemma, because the internal rate of return rule would say that the first project gives you a 50% return and the second project or opportunity only gives you 10% return. So by using the IRR and the idea of mutually exclusive projects, you should pick the first one. So how do you reconcile these two? The issue, it comes down to whether you have $10 available. If you don't have $10 to give, you can't even partake in the second project. But if you do, you're going to get back in dollar terms, which is all that really matters in the end. In dollar terms, absolute terms, you get more back, right? From 10 to 11, you make $1. And that's what's revealed when you do the dollar calculations for the NPV. When you do the rate calculations, you're comparing rates, but your scale is different, so it's not the right comparison. Okay? It's not the right comparison because you're starting off with different amounts. So relatively speaking, sure, this looks better, but in absolute dollar terms, the one that in cash flows, in cash flow, you're getting more in opportunity 2. So this is what we care about. Cash flows. All right. So this will create an issue for comparing mutually exclusive projects. You need a way to scale them in the same way that you can actually compare them. And I'm going to teach you how to do that. Or if you already know, This is just a review for you. There might also be a timing problem. Could be, or alternatively, there's a timing problem. So look here. And this is the same sort of discussion we already had about future cash flows and their trade-offs. So here we have in project A that we're going to compare to project B. We pay out, and so there's an initial outlay of $350 to get these modest amounts early on, but later $200 are coming. So that's much more, in line with what we invested. But in project B, it's a lower outlay, and then we get paid back right away, and then it kind of dwindles. So what happens in the first case is if we were to look at the IRR, it looks like a required rate of return that is low will make NPV higher, right? Because this 200 at a low discount rate will still retain its purchasing power, its power. So for project A, we like low discount rate. But project B likes, or is fine with, high discount rates, right? Because this is going to retain its power, and it's not a big deal what happens over here. So between the two, there's a struggle. It's a tension between these two that sometimes, you know, we'll pick project A if the discount rate was low, but if people are using, if a firm or individual is using a high discount rate, then they'll pick project B. So that creates, we have to put that all, how do we roll that all in together? So here's the project A cash flows in the NPV. And here is project B cash flows in the NPV. And if we calculate them individually, IRR tells us to pick B, but that's not the whole story. First of all, they're investment projects. Let's say that clearly out loud, okay? So these are investment projects. So we should pick the project with, as long as the internal rate of return is higher than required, we would pick that project. But that's not what we're doing here. We're comparing these two. When we compare them, we pick the one with the higher return for investment projects. All right, but like I said, that's not the whole story. The whole story is depicted in this diagram here. I'll give you a chance to go to the... So both are investment projects, so that means that their NPV profiles are decreasing. But project A is steeper. It likes to have low IRRs. Discount rate. And project B is more flat. So we see, that's how we see that A is above B up until here, and then B is above A. So this is a really important, this here, I keep on missing it. Let me make it a little bit bigger. This, I can't get it with my pen, I'm sorry. Try my finger. All right, so there is the crossover rate. So we pick A because A is higher than B in terms of NPV, which is what we always fall back on, up until here, and B is higher than A up until after this point. So we need that point, okay? We also notice that we shouldn't do project A after here, and we shouldn't do project B after here. But if we look at these together, we've calculated them independently, separately, but how do we combine them? So how we combine them is actually, it's not an issue if A was always below B. You see, if B was always above A and hit the line later, then we would just go for B. And we wouldn't mind because A would be consistently below. But that's not what we're dealing with here. They cross over, and one is better than the other sometimes. So what we do is we combine them. We combine them in what's called the incremental project. So I combine them, and honestly it doesn't matter how you combine them, but I recommend, because we have better intuition, I think, for investment projects, combine them so that the first one is a negative, all right? So how do I combine them? I take A's cash flow and I subtract B's cash flows. So A minus negative 250 is negative 100. And A of 50 minus 125 is negative 75. And 100 minus 100 is 0. 150 minus 75 is 75, and so on. So this is called, this has a name, it's the incremental project. Once I do that, I don't look at that. So this should be familiar to you. And now I analyze just these cash flows. So I create the NPV profile for project A over B. In this case, I pick the project A over B, meaning I prefer A, as long as the required rate of return is lower. So I interpret it as an investment project, right? So the internal rate of return of this project that I call A better than B, or A instead of B, or A over B, those all mean the same things. I use this, I interpret this as my internal rate of return of the project. The project returns 8%. So as long as that's better than what I required, or what was required, I should take A instead of B. If not, the only other alternative is I take B instead of A. And that's that. Now I gave you a handout to practice this. How many of you have seen, who has not seen this before? You can write in the chat. I'm going to show you, I have a handout I gave you. So this is new. Sorry, John and Chris, this is new for you? New material? Sorry, I don't even remember the question I asked. New. Okay, so that's, then I'm not wasting too much time. Okay, so I gave you this handout, 3.3, if the number is correct. Like I promised, at the end I'm going to give you all these with the right numbers on them. Okay, new. All right, so great. So I gave you this handout. I asked you on this handout to take these two projects and evaluate them as though, so what did I say? Okay, Draycor is considering the following two investment proposals. As the financial manager, you are responsible for making a recommendation to the board of directors. The projected cash flows for projects X and Y are as follows. Calculate NPV, IRR, and PI for each project and fill in the table below. Oh, I don't have a table, but basically, I guess I had a table before I removed the table. So just basically I want you to compute and show me your formula for NPV, IRR, and the result. They are both investment projects, so there's nothing more tricky here. It's just exactly like the exercise we just did. And what I want you to find is their NPV, their IRR separately, and their PI. Then I want you to answer if these are mutually exclusive, and you were using the different criteria, which one would you pick? Okay, so the only thing I haven't covered is the PI. So let's take the PI, let's get the PI, I'm going to teach you that. and then I'll leave you this assignment to work on, okay? Okay, all right, so let's just save that. Oh, it says, no. I didn't change the heading on that. Some of these say MBA because I use these for an MBA review. Okay, so I'll probably have to fix that too. Me and my typos. Okay, so going back to the notes for a moment, I have to teach you PI, and then we can, this is something else I gave you too, is the summary. This is what we just did today. Okay, so everything is on this page. So just like the formula sheet that I gave you, you can reference this, this summary. Okay, there's all this stuff is here. So work with that summary page at your side. So let me talk about what PI is, and then I'll leave you with all this stuff to work on. I see my little typos. They're not major typos, they're minor, but they bother me. Oh. Okay, so we left off here. Okay, what is a profitability index? So we learned so far about, we reviewed NPV, and NPV was dollars, right? And then we talked about payback period rule, and that was in years. And then discounted payback period rule, which was in years. And then I just did all this stuff with IRR, which was a percent. And so we have dollars, years, and percentage. And finally, I'm going to leave with profitability index, which is a ratio. Okay, so these are different metrics, and they all have different strengths. So the profitability index takes, actually I'll leave that there if you're writing that down. So the profitability index takes the initial outlay, and rather than using it in like an NPV kind of situation, I'm using this terminology, it is just the discount rate that you're going to use, okay? It's called hurdle rate, same thing. It's cost of capital, cost of equity, it's the firm's required rate of return. So anyway, I'm going to make this very simple. There's only two future cash flows that we are concerned with. I'm going to make a ratio of present value of future cash flows divided by the initial investment. So this is the ratio. So it's another way to look at the benefits versus the cost of the investment. So what do? We have to first calculate the NPV. Well, we don't have to do it like this, but it's easy because we have the calculator to give us the NPV. So let's do that. Let's take these cash flows. I'll show them here. So well, anyway, I don't know if you can see the whole thing. Sorry, I make you dizzy. Yeah, I moved it down. Okay, that'll do. So NPV, if you put these in your calculator, will give you 180.99. So yes, it's a positive NPV project. We should invest in it. But I want now to present the ratio. Somebody asked me for the ratio. It's something I want to show, maybe people, this is the dollar return. People understand the dollar return in present value dollars. But it's another way to report is to say in terms of ratio of what you get versus what you put in. So you do that with the present value of future cash flows, which is just this part. Present value of future cash flows offset by the initial investment, which was 1,100. Now notice, I don't put the negative. I don't put it in terms of it's with a negative. Okay, I enter it as though it's already understood that this is the top is the benefit and the bottom is the cost. So I don't have to put a positive or negative there. Okay. I mean, I put a positive, not a negative. So that's how you deal with that. So it's basically benefit over cost is how you think of it. Okay, so if you were to calculate this, I don't do this in this course, but I think if you were to do this for like a finance project would have the benefit first and then the cost below, but we're not going to do that. It's just going to be like investment projects. So you're going to take, this is just this. To get this, let's say I put this in my calculator because there were a lot of cash flows and I just wanted it to be easy. So I put it in my calculator and I got this number. To just get this, I have to add back the initial investment. So that's what the top is. So this is to facilitate your calculations. Use your calculator. So get your NPV and add back the initial investment. You see how the formula works? So the CO is the positive version of the initial cash flow. But I'm giving you in this form and hoping you understand. So CO, did I write it above? CO, let me double check if I put the term, no I didn't. So CO is initial cash flow from the NPV formula. Because I think I have negative CO in the formula on your formula sheet. So this gives me just these, that's what this is, over the cost. So this is the investment. And you get 1.2. And you always want, the rule is greater than 1. That's what you want. Okay, because then your benefit exceeds your cost and you should accept the project. So that's how that works. So you get the benefit. You know, your benefits exceed your costs. That's the best explanation. More bang for your buck is another one that you might have heard in English. Okay, so for every dollar invested, you get 1.2 back. That's what it's giving you. Okay, sorry, I just got a text. All right. Got it? So, just a couple of things to say about PI being useful, its utility. And then, so just a couple more slides. So, I'm going to say something now about capital rationing. So remember, there was independent projects where you just evaluate each project by itself with a rule. So NPV positive, or PI is greater than 1, or IRR is greater than RRR. That's the independent project analysis. Mutually exclusive, we talked about when you have to pick one, you pick the one with the better outcome, or you do the incremental project analysis that you're going to practice. But then there's a situation where you have a budget and you can take more than one project. So here's my example. So you can think of these as millions of dollars. Or just, anyway, they're simple numbers, if you like. So here we have, and this one is 20 million. Okay, so it is in millions. I have to remember. So in 20 million to invest. These are millions of dollars. And you could pick project 1, or you could pick 2 and 3. And here are all the metrics. Here are all the calculations. Here's the revenues you anticipate. Here are, so here's the present value of future cash flows. I split it up. I got the NPV here, and at 12%, that's the rate. And I have the present value of future cash flows, and I computed the PI. So looking at this table without, I don't know, maybe you read it already. Looking at this table, which project should you choose? Should you pick 1 or 2 and 3? So should you pick 1 or 2 and 3? You can afford either 1 or 2 and 3. Which is better? You can't do all of them. You don't have enough. You have 20 million. Okay, so you guys, yes, 2 and 3, 2 and 3. Very good. So you guys know to 2 and 3. So how do you know to do that? What did you use to make your decision? Did you read the next slide? So people who didn't get it, what do I look at? What should I look at? If I look at NPV for project 1, and these are millions of dollars, right? So this is 50,047,000 and present value return. Wow, okay, so, but then if I take 2 and 3, I get more, don't I? So you would actually have to add those together. Okay, you would have to add those because it's project 2 and 3 and it's dollars, so you can just add them. If you use PI, however, okay, wait, let me go back. So that's how you would use NPV. You would have to add these together. You'd have to add them together to be able to compare, which makes sense now that I'm telling you, right? You just compare those. So that's going to be almost 70 and that's 50. So obviously 2 and 3 is better. But if you rank them, if you put them in rank order, it would have shown you that you should pick project 1 because by themselves 1 would give you the answer, would be higher, right? But that's not how you use NPV as a result. However, that is how you use PI. You would take, if you rank them in order, so here I have all the calculations here. So you would compare by combining 2 and 3, you would combine their cash flows and you would get these results instead. And you would see here that NPV is bigger for 2 and 3 than it is for 1. So that's what I just discussed. But when it comes to PI, you don't even have to do that. I mean, that will show you as well, but you don't even have to do that. All you had to do was rank the PIs. It's actually better above. If I put them in order, project 2 is bigger than project 3 is bigger than project 1 in PI. And that's enough to give me the answer. So because of that, these two are higher, so ranking works with the profitability index. and it gives me the right answer. I don't have to make another table. I don't have to make any more tables. Just look here. So that's how you can use PI with capital rationing. So remember that. Okay, that's an advantage that PI has over the others. So each of these have advantages and disadvantages. We fall back on NPV a lot. Even here, we worked with NPV, but we had to combine the NPVs to understand which one was better. John is asking me a question. If the PI of the project 2 and project 3 are bigger separately when you compare with project 1? Well, all you do with PI is you just put them in order and you pick the ones you can afford. Okay, so this one there was just the option of this and this, but I could give you many more projects. All you have to do, calculate PI, put them in order, and take the top ones as much as you can afford. That's how you use it. So read through those notes. In conclusion, I'm going to reference this article that was published. This is by financial economists who looked at this question through interview with CFOs, asking them which methods do they use. That we learned all these different methods. Which is the most popular? Well, it turns out IRR is the most popular, and NPV is a close second. The reason why we like IRR is we don't have to be so specific about our discount rate, and we get a range of possible discount rates to actually pursue a project. Okay, that will defend our argument for pursuing a project. So this is the most popular. NPV is second, close second. Then further down, as imprecise as the payback period rule is, people use it. Half of the people interviewed use it. More than half, 60%. Okay, so, and then they don't even, they don't even know finance, these people, or not them, but the people they have to report to, or people they have to communicate with. They're gonna use the discounted payback period rule less than the payback period rule. So probably the payback period was used in tandem with the other two somehow. Okay, so it was a questionnaire to see which ones they use, not only, right? But okay, so that's why you have some overlap. These don't add to 100. And then the use of PI for capital rationing is not so popular, but hopefully in your practice you'll be able to take advantage of it now that you know its strength for capital rationing purposes. All right, Keith, John's asking a question. 11.9. Yeah, just 11.9%. Yeah. So it's just I think for people's purposes, IRR serves the purpose. So this is the most popular. Maybe I don't know if you've learned PI before, but so it has to do with people liking percentages, and maybe it does enough for them, but they don't realize they also don't realize the value in using the PI for capital rationing. All right, so that's that. So what you're going to do next, because it's almost time. So what you're going to do is prepare the exercises that I gave you, and I'm going to give you something else. I'm going to probably send another email with the right headings, because they all have MBA in the heading. So you can feel proud you're doing MBA work. But this is just review for MBA students. So here is what I want you to do, right? So I want you to, in this space or on separate pages, I want you to get the NPV for X, the NPV for Y. I want you to get the IRR, but I need you to write the expression out. The IRR for X, the IRR for Y, and the PI for X and the PI for Y. That's what I want you to do there. Okay? And then I want you to do this for incremental cash flows. So first I want you to treat them like independent projects, and then I want you to do this for incremental cash flow over here, and tell me which projects you pick. Then tomorrow, actually, I'll give you some more problems. You guys are so good at doing problems. I'll give you some more problems I just thought of to practice, and a set of questions that I guess I could call them, well, they're reviews. Remember last week I gave you review problems, and then at the end I gave you the test type prep questions. So I'll give you the review problems today. I'll give you everything today. Tomorrow we're going to start capital budgeting, and you're going to just keep working with this material that you just need to get through. I don't think it's difficult. There are some points that you have to refine your understanding. Please communicate with me if you need a better explanation, or review these videos if you need to review them again. But I'm going to start capital budgeting, and that's what's going to be on the test on Saturday. We'll be focused on this and capital budgeting that we're going to do. Then next week we are going to focus on risk and return. And essentially, the goal of the rest of the course, well, we have to do some stuff on payout policy, but the goal of next week is going to be to compute discount rates. Like, we're going to talk about how you go about computing discount rates. So we have a lot ahead of us. I'm sorry, the pace is not slow. I hope you had a good weekend and you have energy for this week. Let's not lose the momentum. We're almost halfway through. So have a good day, and I will be in touch by email. Bye.